What's going on, everybody? This is Josh from the Trading Fraternity, and I wanted to make a little video today to explain why you will never become rich trading penny stocks. Now, a lot of people think I have some personal vendetta against penny stocks and that I just hate them for whatever reason. You know, I'm just not a fan of investing them as my primary source of income or even using them as an integral part of my portfolio because it's just plain stupid. You know, a lot of people come when they're applying to my program and they're saying, oh, I want to make money, I want to be rich, this and that. And they come under this premise that they're going to get there by trading penny stocks. You know, look around. Look at the winning strategies that you see people doing in the world and the winning strategies or more or less losing strategies by the other ones. You know, if you're doing something and it's working for you and you are successful and it's making money, by all means, do you. But if it's not working, maybe you should start looking into something else. And even then, you know, this isn't no big secret. Look around. You know, you look at some of the most wealthiest men in the world, let's say Warren Buffett. You know, I know some of you have seen that parody. Have you seen him trade penny stocks? Do you think he trades penny stocks, let alone do you think he's sitting in front of a computer day trading? Just really think about it, you know? And now even take a look. How many of those people that you see being successful on penny stocks, this and that, how many people are like that? How many people are successful off of it besides these guys selling you a program? Take that into consideration, because if it was really that easy, don't you think everybody would be rich at it? Well, even then, before I get going, I'm just going to explain why that's not the case. And if you have any questions, feel free to hit me up. And if you're going to come to me asking, well, how can I learn more about stocks, trading, penny stocks, financial markets? I'm not going to tell you to sign up for my course. I'm not going to tell you to register with me. You know what I'm going to tell you to do? Go read a book. You know, go start learning what a stock is. Go look what real investing is. If you're trying to do this penny stock crap or you're trying to get in these stocks to become this professional day trader when you have no idea what a stock is or how the markets work, I think you should take a step back, because you are setting yourself up for failure and you're just looking to pretty much give your money away. So now with that, let's look at penny stocks. Right here I got Facebook, obviously not a penny stock, and then DIDG. I'm sure some of you have heard me talk about this stock before. You know, I remember telling you guys 4 or 5 months ago kind of the fate of what was going to happen to it. And, you know, if we really want to look back on a chart and see how that's kind of progressed, you know, I think the story says it itself. You know, from 10 cents down to 1 cent today. And that was in July. You know, I think I even told you guys around March 2 when I did it, March, April, when it was around these levels, 4 cents, 6 cents, and then it dropped down to 2 cents again. And you guys got all hyped up, said, oh, it's down, it's up to 10, and now, well, now it's down to 1 cent. Just in the last 2 months, it's down 90%. Now, if we want to even go compare that to Facebook on the last 200 days, the last 2 months since July, when was this little spike? July 9th. Well, from July 9th, you see Facebook at around $65, 66. Today it's at 77. So that's about $12 a share. So this stock went up while this stock went down 90%. This one went up, I'd say, what, 20? No, not 20%, maybe 15%, 10. Now, when you're looking at that, this is kind of the point I'm getting at. And why I'm bringing this up is because often people tell me, and I hear this with my students, I even hear this when people coming up to me the first time, they're like, hey, Josh, you know, I want to start trading, but at this time, I don't have a lot of capital. What's a good amount to start with? I can only afford to play penny stocks. That's a lie. If you are trying to say you cannot afford to play these real stocks and that you could only afford to play penny stocks, when I say real stocks, I'm talking things on NASDAQ markets, big board, S&P 500, stuff like that, because put it into perspective, if you really know what the OTC markets are, where these penny stocks are traded, these are for companies that do not have enough capital to be on those listings. If they're already failed, if they cannot even generate enough revenue to be traded on a actively traded index or exchange, that should even give you a pretty good sign of what they're starting. And I know you guys are someone's going to always give that smart-ass rebuttal about, what about Netflix? What about these stocks that are starting here? Well, yeah, of course. There's going to be, what, 1 in 1,000? 1 in 2,000? And that's exactly what I was saying to the first point. You can make money on penny stocks, but how many are actually going to make it? one of 1,000, one of 10,000, 20,000. Because if it was really that prevalent and it was really that successful, or these strategies really worked, you would see a lot more people flourishing. Now, with that, here's the crazy part that I'm pretty much getting at. You take $2,000. If you put it into any stock, it does not matter how much that stock costs you. 10% of your money, 20%, 30%, 40%, 50% of that initial investment is still the same return regardless of how much that stock costs. You understand that? Because people say, oh, well, I'm not going to make these returns, well, this and that, and then they're always going to come going back to the same literally circular argument talking about, oh, well, you can make 10, 20% in one day on these penny stocks or in this or that. And I'm like, yeah, of course you can, but you could also lose that much, you know? So let's put it into perspective. Let's say you put $2,000 into DIDG at literally, let's start these off at the same 20-day period. Give me a second. So you got it at 0383, right? For 2,000 shares or $2,000 worth. 2,000 divided by 0.0383, and that's being generous. 83. You get 52,000 shares. At the end of that 2 weeks, or roughly 3 weeks, if you held that stock, and I know you say, oh, well, the point is to liquidate quickly and take a gain, take a look at this chart. After you buy it there's literally been only one opportunity for you to sell it for more than you paid, and that was the next day after. And then one time about 1, 2, 3, 4, 5, 6, 7, 8, 9 days later, and you would have been able to sell it just slightly higher than what you paid for it, and that's assuming that you got in at the opportune time and were able to sell at the highest point of the day and execute 100% perfectly. Other than that, where's your money gone? Take a look. It's down to 0190. So now, pretty much your $2,000, your 52,000 shares times 0.0190, your $2,000 just turned into $992. Great return, right? You go and do that same thing with Facebook. You bought in on the same period. These are the same. You could have had the same opportunity. You know, August 7th, you put $2,000 in at that closing price of $73.21. You're getting about 27 shares. Now you're like, okay, that's not that much. I could have had 52,000 shares. Okay, but look what happens over time. That 73.18 that you paid for, stock closed on Friday at 77.31. Congratulations, you just made $112 in 2-3 weeks. Like, oh, well, that's not a lot of money. Well, what's the point of that? And, you know, to some people it may not be, but that's assuming you're using a small capital size of $2,000. But now let's go back. Which one sounds better to you? Making $112 or losing $1,100? I think it's pretty easy to tell which one you'd want. But now, this is what I'm getting at in terms of risk management. You see Facebook. These stocks move slow over time. And I'm not saying just Facebook. I'm talking about a lot of these bigger board stocks that have established their reputation, are backed by real fundamental aspects of business, and can be verified by many other sources to their values, you know? And when you put that into perspective, you put that $2,000 in, for you to take an $1,100 loss with that $2,000 loss on Facebook, for you to see a 40% drop at open, like we saw on August 27 with DIDG, and I could go down the list and give you hundreds of other penny stocks that do this exact same thing. For you to see a 50% drop in your money on Facebook, it would literally take Mark Zuckerberg to be a child molester. You get the analogy with that. It will not just drop like that. You are not putting your money at risk. You are in a safer investment that still has the ability to produce a return for you. You know, you're saying that's only $2,000. Well, guess what? You started off with $2,000. Let's say that was $4,000. Your return would have now been $200 in 3 weeks. Now, going back to that example, for you to see Facebook drop 50%, it'd take Mark Zuckerberg to be a child molester. For you to see DIDG or one of these penny stocks go down 50%, all it takes is the opening bell to ring. All it takes is somebody to tweet something, for somebody to dump shares. I think it's pretty easy to see. You guys get the idea with that. So I'm getting a phone call, but, I'll leave it at that. Stay in school. Have a wonderful day.